But let's figure out what's happening in the market. Mohit Khanna, CFP Fund Manager at Purnartha Investment Advisors, joins us in the show right now. Mohit, hi, good morning. Welcome to ET Now. And, Mohit, looking at the screen, the question is how much more pain, right? That's all that anyone wants to know. I know no one can call the bottom to the T, but you want to know whether a major chunk of the pain is behind us or not.
Hi, good morning, and good morning to the viewers here. Uh, well, it's very difficult to call out, right? As you rightly said, what happens in next 2 months, we expect some volatility to continue in the near term. But I can tell you one thing, clients investing money today will be a very happy client 2 years out. So we are investing. We continue to deploy capital on a steady state basis. However, we have slowed down a little bit, but we continue to deploy capital. We expect some volatility, and that should be fine in a couple of months.
Why do you think clients will be happy? I mean, for clients to become happy, returns have to come. Do you think from here, next 2 years, money will be made?
Yes, of course, of course. If you see the underlying growth trajectory, after this correction as well. So correction has taken off a lot of excess in the market, and there might be little bit some left. But somebody who is coming in at a relatively better valuations today is bound to make money. And if we look at the India growth story, over the next 2 years, it should play out really well.
Let's throw in the word valuations and earnings here. For markets to go, valuations have to look attractive and earnings have to improve. Let's first start with valuations. Are valuations really looking attractive?
Well, in certain pockets, yes, we do have a lot of stocks, a lot of sectors that are presenting value. But in the recovery, whatever short-term recovery that we have seen up till now, short spurts in that manner, the growth aspect has performed relatively better. So if you see after this correction, there are multiple pockets of better valuations, but the recovery that is coming in or the market what is favoring is growth. So value seems little bit abundant, whether it's a mid caps or small cap space, but one has to be really, really careful and calling out a pure play bottoms up strategy wherein you have to focus on the earnings recovery. Overall, in the sense, we might be on the index level, might be little bit overvalued, but that's fine. But if you see the deeper aspects of stocks, multiple stocks have corrected to a lot of value.
All right, Mohit, but within the auto space, what we understand is that you are holding a constructive view there, but now there's a bifurcation clearly in terms of the new age EV players as well as the traditional OEM players, which now have a majority of the chunk coming in from EVs as well. Give us a sense
Right.
that where are you betting on?
So we do like a good mix of both ICE and EV in the two-wheeler space. I think the cash flows will still continue to come from ICE, which used to be deployed in EVs, and that market or that part of the revenue line should be built up by the two-wheeler companies in next coming years. So they already have a good market share now, and but the overall market share for EVs in India is sitting somewhere around 5.5-6%. That should start to go up eventually.
So I'll start picking up, and I've had the pleasure of tracking your firm and the good work for many years now. You believe in taking big bets, 7, 8, 10 big bets. What are your concentrated big bets right now for next 3 to 5 years?
Well, in the mid cap space, mid cap fund that I manage, over there, my big bets is somewhere is in the FMCG. It's in the consumer space. I have big bets in mining, one of the mining companies as well, one of the healthcare hospital companies. So those are the sectors wherein I am quite bullish on.
PMS schemes, they share the top 5 holdings, something which gets in the public domain. So if I could encourage you to share information which is in the public domain, let's say your top 5 holdings.
No, I won't be able to share the particular names. I don't think I have that compliance clearance here. But if you could look at, my 35% of the portfolio here is anchored for rural recovery. My another 35% portfolio is into defensives. 20% is into capital goods, defense, railways, mining. Then I have around 4% cash on the portfolio level, and then remaining is in the financials, in which the lenders are little lower, the market infrastructure financials are little higher, because that I see as a structural growth story going forward.
All right. But Mohit, contrary to the consensus view of the market participants' financials, where you have a neutral stance there, help us understand that why the space is not looking that attractive, because there's a lot of discussion regarding the valuations comfort over there. Give us a sense, how are you looking at this space?
Well, yes, there is certain level of valuation comfort, in financials, and because they have not really participated as much. But if you look at the positive triggers that the valuation needs to, really convert into the growth category where actually you try to make money, that is lacking. So if you see the recent news flows, the pressure on NIMs still continue to persist, and this is specifically for the mid cap space, in the banking on the banking side. So the pressure on NIMs continue to persist. Then you have issues going on with the MFI space. We don't really see we don't really see any big recovery happening on the lower provisioning side as well. So I think we still have couple of quarters for the banking in the mid cap space to sort of turn around and come back to the growth trajectory.
Mohit, I don't know if it would be fair to ask you what have been your recent buys or recommendations, and what is it that you've sold?
Well, if you see, as I just discussed, in December, we increased our allocations for defensives and consumer recovery. That fared out really well over the last couple of months. So we did all that portfolio rejig by December. In terms of selling, it is much more a bottoms up, wherein we want to move out of stocks which have done decently well, or they are not looking as a structural stories as of now. So we want to be very, very sure of revenue and profit and EBITDA delivery by the companies over the next couple of quarters, because I think that will become a key differentiating factor between the performers and the underperformers.
Mohit, with this, we'll let you go on that. Really appreciate you taking the time out and speaking with us this morning.
Thank you. Thank you so much.